Right, welcome to 2022. So I've been away. I've just come back, getting back into gear. Where do you want to start? Where do I want to start? I'm going to start here. Look at this chart. This is probably the most unsexy but most influential market around at the moment, I think. This is the US 2-year notes. So I've been short these. This is the yield, right? So it's been going well for me. Very unsexy, very boring, but great trade. Just sit on it and roll it. It's got more to go. The crazy thing about this is, right, so this is back, throughout last year. It's down like 10, 15, 20 points, right? It's now at 100. That's like a 10 bagger. If this is kind of, can you name anything else that's gone up like tenfold, right, in the past 12 months? Not even Bitcoin's done that, right? Everyone loves Bitcoin. And what about the old 2-year bonds? They're a bit more substantial and more influential than Bitcoin. But the funny thing is, the equity markets have been ignoring it since basically September last year. The equity markets there up 10%, maybe 5%. It's certainly higher. Maybe not so after this week. But they're certainly not down despite this going on in the yields. Now, the question is, when we zoom out, look at this, right? This is a classic. We're going to look at this in a couple of places. This is a classic technical gap fill, right? That's what happens. Let me look at it even wider. Let's look at it on a monthly, right? You can see how far it's potentially got to go, right? Look at this. These things have got, on a technical basis, quite a lot to go, right? Even just filling this gap, they've got another 50 points to go. Like basically that's 140, 150, something like that. To get back to this trend line, we're talking like 2%, that's another 100 points. To reclaim this high from 2018, right, that's almost another 200 points. You've got a long way to go still. So it's actually not too late to get on this trade, I don't think. And when you think about the Fed, like inflation at 7%, the Fed's at 0, negative rates when you actually include the QE, right? That's 700 points, minus 700 points real rates at the moment. And they're thinking about like 0.25. That doesn't even going to touch the sides, right? And their target is 2 to 3% of inflation, right? And 2%, that's the lower end of their inflation bound. That's their target, right? And inflation's actually 7%. Inflation's up here, right? Their cash rate is here, right? There, so they've got a long way to go to raise these rates, right? Now, when you look at it in the bonds, right, you can see how it's rolled over as well, like the bond futures, right, in terms of price. You just see how it's rolled over. Look at that. That is a classic rollover. We've seen that gap filled, and it's said like a long way to go. So these are the 2-year bonds that I've been short. Now the interesting thing is the equity markets have really been ignoring this. But you're starting to see a little bit of attention coming through in the wonderful Russell. Now look at that. Looks pretty familiar, doesn't it? Right? These are the 2-year notes. Price. Look at that. Rolled over. Filling the gap. Let's look at the Russell. Right? The Russell's paying attention. These are the smaller companies, right? These ones, they're kind of more sensitive to debt. Look at that. That's a good gap to fill. Let's have a look. How far is that? 22%. Now, the funny thing about that 22%, right, is the last time that these rates went up here in 2018, there was, surprise, surprise, a 20% correction in the stock market, right? And when we look at the Russell, it's pretty well and truly poised started to roll over more clearly than the other indices. And the other indices off their highs, but this one's really rolled over. And you can see it clearly, like in the when you look at the lines, when you look in the bars, it's still there. The candles, it's not as clear, but it's still there. And when you roll out to the dailies, you can see how it has rolled over and broken these levels. So there's a level here through there, right, that it's recently broken, just the last couple of days. There's a level here where it is just sitting on at the moment, ready to capitulate. As you can see, where it comes down, that'll be 20% from where it is now. Obviously kind of more from like 30 something, 35% from the top when it comes back to fill this gap in here. If the technicals on the 2-year notes are anything to go by, this is the one market that is really starting to show it's paid attention to that. Right? Let's have a look at the US, the 10 years, because they've been on the move as well. You can see how they're moving, and they've got a fair way to go. This is going back for decades, right? And again, we can see in here, right, that the last time it spiked above this line, again, that was like the end of 2018, triggered a 20% move in the share market, right? And 20% move down, and it's just starting to do that as well. And it has broken these technical levels, right? And that is a good target in my mind, that previous high there. Again, keep in mind, that's like, 140, 150 points from where we are at the moment, right? But at 3.2%, that is still way below current inflation and still only just on the longer term inflation target. 3.2% for a 10-year bond, 2 to 3% inflation, that's like, between 1 and 1.25% real interest rates. Very realistic target. So that's the bonds, and the Russell is paying attention. When we look at a few things like the Nasdaq, I mean, again, like on the monthly, you can see pretty clearly monthly, it's started to roll over. I mean, this is cheating a bit, right? Because it's on the linear scale, on the log scale, it's not so clear. You can see just how it started to roll over, and it's at some key levels here. That is a big red line in the sand, that one that I would put. So you can see it's not as rolled over as the Russell, certainly not as rolled over as the 2-year notes and the 10 years, but it is getting there, it is starting to pay attention. And you can see on a few measures, like that one, that it has broken that longer term trend. I mean, you can read it, go back as far as that. It's still broken it depending on how you draw these. That's probably the most relevant one, really. But it's certainly forming a lower low. This one is a key level of support, and that coincides a little bit with the story that we're seeing in the S&P, where again you can see that line. It's just holding, it's kind of hanging on for dear life at the moment. This is not looking very good at all, and there is a long-term trend that has been arguably broken. You can see it there pretty clearly on those lines, just where that that resistance it's broken through. Since then it's traded above that line. So it's looking a little bit pear-shaped. Because I've been away, I haven't had any positions really on in the equity futures. I've just been short the bonds just because they're so much easier. They're just less volatile. It's the same macro trade, right? It's the same macro trade, which is the story of the Fed dealing with inflation, and that has ramifications for the bond market, obviously, and the equity market. The equity market's playing catch up. So I'm looking to short this. It is a little bit tricky at the moment, like what to do with it, because it's obviously had a sell-off and it's pretty weak on the RSIs. So one of the indicators that I look at really is particularly the 4-hour RSI. Like if something is overbought or oversold on the 1, 2 and 4 hours, for me that's a trade that I put on in the equities. But at the moment, for me, this is more of a, as a swing trader, this is a buy, right? But given my macro view, I'm conflicted. I don't really want to buy it because given what's been going on in the bonds, I think, and there's some of these trends, I think it's due to break. But it's, the technicals, which you kind of should trust, some may say it's a buy. So I'm conflicted. So that's why I haven't had anything on, right? Again, it's like oversold, hitting a major support level. Technically, that is a standout buy, but the Fed could come out in as early as February and raise rates, and it could be a shock. I do remember back in, I think it was 2000 or 2001, the Fed came out with a surprise interest rate move in January. I was trading interest rate options book at the time, wreaked havoc with the markets. They've done it before. I don't know if they'll do it again. They've kind of got a bit more diplomatic since then. I think we're going to look at, actually, let's go back to these 2 years. We're going to look at gold. And the reason we're going to look at gold is because it's been a little bit, it's been kind of strong. Let's do this one. It's been a bit strong, and that's been surprising me. I've got like a very small short gold position on. Now, the reason for that is when we look at these charts, I'm just going to try and line them up as best I can. Yeah, back to 2011. Right, we can see a few things going on here, right? It's like, look at this date, right? So this date, like in end of July, beginning of August, these 2 yields, they hit a ding-dong low of 9 points. That coincided literally, to the day with this high in gold. Yields hit a low, gold hit a high. Okay. Back over here, again, it's the lining up is a little bit more tricky back here. Bear with me. Yeah, that's it. Again, we can see the same thing, right? These yields, they hit a low, 17 points there. And it's on the 29th of August. 29th of August here, gold hit a high. This is what has been happening in recent years, recent decade, between gold and these yields. And you can see here, there's this shelf there. We've got another shelf that's been going on here. And we have a series of lower highs. We have a series of lower highs. And it has been coming off a point, right, where it was a high in gold corresponding literally to the week with a low in the yields. Let me just line all this up, hey? Right. So that's why I'm short gold, right? But the interesting thing is, right, well, I guess to delve a little bit further, we can see there's a low here in gold where it started to take off, right? And of course, what does that correspond to? That corresponds to the turning in the yields here. A little bit of a mismatch, to line it up. Right? But that's that. Yields kind of turned here. Gold, that's when it took off. So we have a situation really of yields going up, right? Gold goes down. Gold goes up as yields go down. So what we've got here, we've got yields are going up. Gold is hanging in there for dear life. Okay, that's why I suspect we're in for a bit of a tanking in the gold market. And we can see here, right? Let me go back to these vertical lines again. You can see here, when gold fell off a cliff here, right? That, of course, corresponded with a noticeable spike up in these 2-year yields here, right? You can see how they broke that, okay? And as it broke that, broke up, gold went down. Now, to me, obviously times, there's a whole lot of factors that are different now to then, right? But to me, gold is very susceptible to waking up to what's going on in the yield market, right? Just as we've seen the equity markets hanging in there, gold's been hanging there. And I think the gold market has been ignoring what's been going on in these bonds. This has been the quiet mover, right, in the markets. I mean, that's a big move, right? From, over the last 12, 18 months, right, from 10 points up to like 100 points. And gold has done nothing, and the equity markets have rallied. This rooster is going to come home, and it's not going to be pretty when it does. The last thing I'm going to look at, of course, which is sort of related to gold, because it's a similar thing, of course, is Bitcoin. I don't invest in Bitcoin. I think it's a joke. But I'm going to point out just a couple of things here, right? Look at this. The last few times Bitcoin's had a correction, 93%, right, here. And then 87%. This one, 84%. Where's it going to take it to? 84%. It'll take it down to like 11,000, something like that, right? What a mess. Won't that be funny when that happens? Now, if we go down a little bit further, one of the things that I think is interesting in the moment, and a technical thing in Bitcoin, is it's doing this. I'm not a big believer in these head and shoulders, right? But they do occur, right? And when we look at that one and we take it from the high to there, right? And then we project it down, right? Where's that going to take us to? Down there. That's going to take us down that 15,000 mark. That's not far off that 80% mark, right? That's 77% all up. That's what you do with these head and shoulders. You take the distance from the technical guidance, really, is from the peak to the shoulder to the neckline, right? Whatever that distance is, that's how far it's got to go, right? That would take it down to like 15,000. Okay, not pretty at all. Massive de-risking situation, but that's really what I suspect is going to happen in Bitcoin on a technical basis. And when you look at that level from where it could come down to, that's really the level around about that 12,000 level that it broke up from. So that's certainly within the same, sort of within QE. I mean, that's like 82%, right? That's within the same ballpark as this head and shoulders correction. And I'd say if we kind of look at some of these trend lines, look at that, from there to that correction, coming up through here, to me that makes a lot of sense. So that's Bitcoin. That's a bit on gold. The last one, the Aussie dollar. So I had a little short position in the Aussie. I squared up before I went away. Had a little short one before, I caught this move. From 72.80 down to like 72 cents. This is just looking like a bit of a bear flag to me. And I'm looking to re-short it. That's what I think is potentially going to happen. Maybe at this level, maybe 73.30, it might get as far as that. There is a FIBO in there that it might respect, right? That 73.40 level, that would be a really good target. Okay, because that's like a previous level where it had spent a bit of time. Yeah, give it a bit of run up to there, 73.30. Probably on the RSIs, it would probably come up as coming up to there. Yeah, it's like on a daily RSI. Yeah, when it comes up to there, that might be overbought on the daily RSI. That would be a good target. I think that's what I will be looking for on the 4 hourly. That's why I sold it when I was up here, because it overbought on the 4 hourly, right? And just wrote it down there, hit that bottom of the trend line, squared it up. I'm out, picked up a cent, and I think when it comes back up to here, which I suspect it will, that'll be time to go short again. So look, that's pretty much it, really. These equity markets, they're looking susceptible to waking up to what's been going on in the bond markets. So I've been short the bonds. They've been great. I've been short like the Aussie 10 years like for a year. I looked at the trade the other day. It was beginning of January last year. I put that one on. They're my favourite trades, the ones that just got like fundamentally good value. You put them on at the right time and you can just sit there and roll them. They're in and out during the day. It's tough work and it is hit and miss. Whereas those good long-term value ones, that's what I like. I'm looking at a good long-term short actually in these equity markets as the time comes. But again, the volatility is tricky in the equities. Whereas in the bonds, which is essentially like a proxy, right, a similar kind of risk scenario, it just makes it a lot easier. But look at that, William. If you trade the equity markets, this is the little canary in the coal mine that has been choking for months. Pay attention to it. All right, that's about it. Have a good one. Catch you later. Ciao.